Welcome to the Ask Brad Show. Be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. And now, the host of the Ask Brad Show, here's Brad Williams.
Do you plan to retire anytime in the next 5 years? If so, the clock is officially ticking. But there's a lot more work to be done. And you know what? It's a lot more than you probably know. Planning, preparation you do now, what you do today, could determine your success or failure. Welcome. This is Brad Williams and the Ask Brad Show. And today, we're going to reveal 5 critical steps you must take now before you should ever think of calling it quits from your job. Now, everybody knows saving and investing retirement is how you got to get started. But what you do with the money is what matters. If you retire and you haven't covered all your bases, you're setting yourself up for a big financial fail. Let's talk about what those specific steps are and how you take them in the years leading up to retirement. Coming up on today's show, I'm going to break down a 5-point checklist that you can't afford to ignore, including things like tax-efficient strategies that could help you save thousands of dollars in taxes in your retirement, and why claiming Social Security is more complicated now than ever, and how to avoid leaving tens of thousands of dollars in benefits on the table. And these are benefits that are rightly yours. We're going to talk about successful strategies to invest for income while minimizing risk, and a lot more. So, most of your working life, you're thinking about the steps you need to take to retire. And, thinking about these, they probably weren't a pressing concern. You probably thought from time to time, when you looked at your company handout, what am I going to do with that? When you look back, retirement was like a vague, distant concept rather than something that would actually happen one day. And then suddenly you hit your late 50s, certainly in the early 60s, and you realize without really becoming aware of it, boom, it's here. And then you realize you've been paying attention to those commercials about annuities, reverse mortgages, Medicare, and you're not tossing out those AARP mailing, right into the trash because retirement looms with a terrifying urgency. In fact, I met with a client today. She's transitioning out of her job, and she's actually on medical leave now, not because she's sick, but because she's burning it up. She's officially in retirement, although she's getting paid full. And she was telling me, because I've been helping her extensively get ready for this, she said, Brad, God, this is hard work. I didn't realize all this stuff was so complicated. Well, doing that planning in advance is real important. When you ask yourself, do you have enough savings? Is your money invested too aggressively? Maybe not invested aggressively enough. Will you need long-term care insurance? And I think that's a misnomer because it's not so much that you need insurance as that you just have a plan, however you're going to pay for it. Do you have a will? What on earth is a reverse mortgage and why would somebody want one? So you have this abrupt awakening and it's like a panic attack. It's about 5 years out. But you know what? That can be a good thing. And the reason is these years are critical because the moves you make in that transition period, which is now right before retirement, they're going to substantially improve your life in retirement. And I kind of look at it like I've done a show on the retirement mountain. It's like climbing the retirement mountain. As you're going up, you're in the accumulation stage. As you're going down, you're in the distribution stage. And the fact that there's a preservation stage, and that's at 5 years or so before retirement, where you got to take a full inventory, reassess your strategies, and see what you've got. So in that 5th year, you're looking at that. Okay, now in the 4th year, you're going to start looking at tax saving strategies and how to manage this early in retirement. And that's where you lay the groundwork, because once you've retired, it's oftentimes too late. So you want to start a tax and income planning process today, because as I mentioned before, it's what you do early that matters later. So then you got 3 years to go and you want to put aside some time to contemplate what retirement will actually mean for you. What are you going to do and how are you going to pay for it? And then as we look 2 years to go, you want to look at the ways to reduce spending and really focus on how you're going to draw your income. So increasing your income, which means you probably ought to be increasing your safety. And then the final year, you review everything. You want to get a second or even a third opinion. You really only have one chance to get this right, and you're now at the threshold. Get with us. Give us a call. Let us know what you're interested in. 844-343-6048. That's 844-343-6048. So again, there are 5 critical steps to take before you fully retire. Step 1's about taxes, and they play a critical role and have a profound impact on your retirement. I mean, taxes are the biggest expense for most people in retirement. If you're in fairly good health, you'll probably find taxes are the number one thing and not necessarily healthcare, at least for many years anyway. So if you don't have a tax efficient strategy, you could be paying tens of thousands of dollars or even more. And there's a big difference between tax preparation and tax planning. You know, when you go to your CPA or your accountant, your tax preparer, they're preparing your taxes, making sure everything, you know, all the boxes are checked and that all your 1099s, W-2s, whatever are included. But if you really want to pay fewer taxes in retirement, that's a forward-looking tax planning strategy. It's not about how much money you saved, because contributing money to your retirement account is easy. It's when you withdraw the money, how is it taxed? That's a different ball game. You know, a lot of people think, well, you know, I'm retired. I'll sell some shares of my Amazon or Apple stock or my favorite mutual fund. But if you're doing that for income, you could be really building a bad plan in there, because in a down market, you're going to have to sell more shares to keep that same income. So when the market comes back, you're going to have fewer shares for the future. So you got a double whammy on your losses. You not only lost it today, but you lost it from the future. So, you know, Albert Einstein once said, doing the same thing over and over is a definition of insanity. And we look back in the last 18 years, we've had 50% losses since the beginning of the new millennium. What would a 50% loss do to you today? Today, you got to answer that question for yourself. What would a 50% loss in the market do to your retirement? And then you got to do something about it. And that's getting a second opinion. So you don't want this to happen. I don't want it to happen. Retirement's a huge decision. You got to take the steps to get it right, and you only got one chance. So, you know, when you look at things, you could be paying additional taxes, fees, and penalties. The thought that you were counting on this money to get you through retirement, it could be a fraction of what you thought it would be. Because when you hit 70 and a half and those required minimum distributions begin that are required out of your IRA, 401k, then you got to look at taxes, because if you think you hate paying taxes now, just wait until you have to withdraw from your IRA or 401k. But you can control that. RMDs, required minimum distributions, are widely misunderstood, and really a lot of people ignore them until they happen. So the key is to address that issue early and take care of the tax problems early. So as we sit here, what are the solutions? Well, one, depending on your situation, might be beneficial to have a Roth conversion strategy to systematically start converting some of those accounts to Roths or part of them. It could be that your employer allows a Roth contribution. You may want to start changing your amount that you contribute into a Roth versus a traditional. Now, you don't get the tax deduction, but what happens is you get tax-free income once you start taking distributions. So you're changing tax certainty for tax uncertainty. So when you look at things like Roth IRAs, interest from municipal bonds, withdrawals from life insurance, you know, these are some things to look at for tax efficient strategies. Because right now the IRS is licking its chops thinking about your IRA, knowing that all that money's been compounded and you're going to have to start taking out, and that's when they get their payback. So you got to keep that in mind. Keep that in mind. And what I do is I help my clients with forward-looking strategies that help them legally save thousands of dollars in their retirement. And I show people how to prepare a retirement tax savings action plan. When's the best time to withdraw from your IRA, your 401k, other retirement accounts? This Trump tax plan presents an opportunity for a lot of people. So if all this makes sense to you, give us a call, 844-343-6048. And we will give you a free consultation to talk about these 5 steps and give you that second opinion as you're transitioning into retirement. That's 844-343-6048.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working. Taxes, taxes, taxes. It's not about how much you make. It's about how much you keep, especially in retirement, especially with a new tax law. Going forward, what will this mean for you and your taxes? Brad Williams has created a tax cheat sheet. It's a 2-page reference guide on the new tax bill and how it may affect you. For your free tax cheat sheet, give Brad a call at 844-343-6048. That's 844-343-6048. Or visit AskBradShow.com. That's AskBradShow.com.
Now, today, as we come back, we're talking about people who might retire in the next 5 to 10 years. So, as I mentioned before, you're really officially in countdown mode. If you don't have your financial plan all buttoned up, you could be setting yourself up for a big failure. So the 5 critical steps now that you really need to take care of before you call it quits. Again, you got to have a strategy to maximize Social Security benefits because that's one of the few guaranteed sources of income that people have right now and should be the backbone and foundation for a financial plan. You paid the money in, you're just getting your money out, but you want to make sure you get the maximum you can. So many people leave so much on the table because, they claim it too early. They forget about how that affects their spouse's benefits. And, if you want to go to my website, AskBradShow.com, I've done some shows on Social Security. I've done some shows on income planning. That's not what today's about, but you can go back and listen to those. In fact, any of my shows are on my site, AskBradShow.com. So when we look at all the rules that are involved in Social Security, how and when you claim, these mean money to you. I've often told people there's 2 systems of taxation in the United States today, and I'm quoting from a New York Supreme Court judge from the 1930s. He said, there's one system for the informed and one system for the uninformed. And you're listening to this show probably because you want to be on the informed side. Well, that's my job, is to help you be informed. So looking at tax strategies through making sure you're maximizing Social Security income and minimizing taxes is really, really key. Now, what you might want to do is take IRA withdrawals to allow you to delay Social Security. Because once you hit your full retirement age, when you see that FRA, full retirement age, you start getting an 8% deferred retirement credit. And that will last until you hit 70. Now, there is absolutely no reason to wait till after 70 to take your Social Security because you're just leaving money on the table. But it could be that taking money out of your IRA or 401k might be a good idea to allow you to defer your Social Security and get the maximum amount out of it. And again, that depends on your situation. Some people may have to take Social Security as quick as they can get it. I hope that's not the case for you, but if you can wait, just remember claiming Social Security is complicated and there's a lot of trap doors in it. So don't leave money on the table. You know, your best defense is to make sure you wring every nickel out of the benefits. And with our 5-point Social Security analysis, you can discover the precise time you'll get the most out of your benefits for you and your family. There's a little known trick for boosting spousal benefits, strategies to eliminate or minimize taxes on your benefits, and you might be eligible for additional benefits. We can cover that. So if you're one of the first 5 callers today at 844-343-6048, that's 844-343-6048. I'll tell you how you can get your free Social Security analysis right now. And it's free for listening to the program. No cost, no obligation. 844-343-6048. Now, when I look at past meetings and, about 9 out of 10 of the first time client meetings, and I look at where they're invested the same at 65 as they are at 40. And as our old President Bush used to say, that's just not prudent. I remember Saturday Night Live used to do a good thing on that. Dana, whatever his name was. But you have to change your strategy as you get older. You've got to reduce your risk on your portfolio, or when these big dips happen, and they will, you'll be ready. So if you're thinking about retirement anytime in the next 5 years, like I said, your clock's officially ticking. The 5 critical steps you must take now will help you plan that out. We're going to talk about updating your investments and doing more with the investments while minimizing risk. Everybody wants to talk about asset allocation and diversification. And that is very, very important, because a properly diversified portfolio, one that mirrors your appetite for risk, not your advisor, not your uncle, not your brother, but your appetite for risk, can help you through market downturns. But as I look at new clients, oftentimes they're really not prepared for that. They're just crossing their fingers and hoping that they'll make it to retirement without another major downturn. They take on more risk than they know, and they've really got no plans to protect themselves. I call it defensive investing. Show me someone who lost their shirt in any of the previous market corrections, and I'll show you someone who didn't have an updated or diversified plan for managing risk. Because you really can avoid potential market downturns by having the proper risk management strategy. I said earlier that Einstein said doing the same thing over and over and expecting different results is insanity. Well, here we are. People are a little cautious right now. But for some reason, many are still thinking, well, it's going to continue to go up. And I see that by the way I look at portfolios when people first come in to see me. So we are really way overdue for a bear market correction. And typical bear market lasts a year and a half with an average cumulative loss of 41%. And that could be trouble, especially if you're this close to retirement, because your strength in the past and why you had time to make it up is the very word time. You had time. So when you don't have time, you got to reduce your risk. We saw just about all, if not all, of 2018 solid gains disappear. When I ask clients, how'd they do in 2008 and 2009? Did you lose tens of thousands or even hundreds of thousands? And in early 2000s, were you caught up in the tech bubble? That's twice in 9 years that Americans got creamed in their retirement accounts. So if you don't want that to happen to you, why don't we have a conversation? Just give me a call. We can have no obligation conversation, discuss your risk, and discuss what defensive investing really means. Just call 844-343-6048. That's 844-343-6048. When you retire in a bull market, of course, you're in good shape. But what if you're retiring in a bear market? Why take the chance that you're going to be in either? Why not have an exit strategy in advance? And when we look at things like required minimum distributions, which start at 70.5, bear markets can kill you in those, because if you're having to take a certain amount of money out and the value of your shares has dropped, you're going to have to cash out more shares to get that same amount. So having the right strategy for getting income from your retirement accounts, such as dividends, interest, things like that, makes more sense than cashing out shares. For example, do you know the investments you own? Do you really know them? Do you know your asset allocation? Do you have any clue of what your downside risk is? Because you need to know the answers to these questions. The sooner you do, the better off you'll be. You've worked hard, you made sacrifices, but now what? It's what you do with your money that really matters. What's your plan for Social Security, for Medicare, for taxes, for health care, long-term care, required minimum distributions? There are many things. And my 5-step retirement action plan focuses on these 5 key things. Single most important strategy is ensure you wring every nickel out of your Social Security. And the latest wrinkle in Medicare and how you can avoid getting gouged in premiums. And a lot of other strategies that successful people are using to ensure their money lasts as long as they do. So if that's what you want for you, be one of the first 5 callers, 844-343-6048. That's 844-343-6048. And we can talk about this 5-step retirement action plan and whether it might benefit you. No cost, no obligation.
Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com.
We're covering the 5 critical steps you must take now before you can ever think about calling it quits and retire. We went over healthcare costs, long-term care, required minimum distributions, strategies for investing. But when we look at, as I mentioned, taxes will probably affect the most people as far as being the biggest expense. We have to look at healthcare expenses. You've got Medicare premiums. You've got whether you have a supplement or not. Those of you who are in the military, looking at TRICARE for life. What are your deductibles? What are the copays? How long do you think you're going to live? I mean, everybody wants to live longer. Of course, we want a quality life, but we got to remember we're going to be paying for health care. Because if you look at your retirement in 3 phases, kind of the go-go years, the slow-go years, and the no-go years, we have to plan for these things. There's a lot of talk about long-term care. I did a show on long-term care. I'm not going to spend a lot of time with that now, but that's something that needs to be looked at. And what I mean is not necessarily long-term care insurance, but having a plan. There are several ways to take care of that issue that don't require insurance. Have you looked at those? Because that's something we may want to talk about. There's been a lot of changes in that long-term care insurance arena, premium hikes that have been significant, underwriting's tightened up so much that only the cream of the crop's going to get approved these days. So looking at long-term care with someone who understands it like myself is going to be really important, because health care is going to be a large cost of retirement. You got to think about that. That's where taxes come in, because taxes can impact your Medicare premiums. All these are important. So really, as we wrap up, successful retirements are not built on assets, the money you save. It's built on your ability to generate income. So you got to have diversified sources of income. And getting income today is tougher because interest rates are low, although they are going up. And you've got to have the right strategies. So if you're having a fear of running out of money, I'll show you someone who doesn't have a plan for generating income. It's got to be diversified, and you got to take into account many different factors. So call in, get our 5-step retirement action plan. And that's when we talk about the 5 biggest issues that could help make your money go further in retirement. We can schedule a time to meet, review. I can share my thoughts with you. No cost, no obligation, no sales pitch, no pressure, no products to buy. Just conversation and getting a second opinion. So if you want to schedule this, just give us a call, 844-343-6048, and tell them I want to talk about my 5-step retirement action plan and see how it impacts me. 844-343-6048.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
Hello, this is Brad Williams with Brad Williams Financial Services. Deciding when and how you retire is one of the most important financial decisions you'll ever make. Should you take a lump sum? Do you have to pay tax on this money? How do you invest the distribution proceeds to make sure you don't outlive your income? With such an overwhelming number of investment options, one of the most important decisions you can make is to seek the advice of an advisor. For this important partnership, you need a highly trained and experienced professional who sees your total financial picture. Someone who can help you define your life goals, establish the right financial plan, provide strategies focused on your needs, and help you stay on track. So if you or someone you know just retired or is thinking of retiring, give me a call today. I'll provide a tailor-made analysis of your retirement options at absolutely no obligation to you. Can you really afford to retire without knowing all the facts?
Call 844-343-6048 or visit us online at AskBradShow.com. Thanks for listening to our show today. In retirement, you only get one chance to get it right, and we know that proper information leads to informed decisions. And that's why we hold free informational workshops in our area every month. Topics like Social Security, RMDs, the latest retirement tax strategies, IRAs, estate planning, and so much more. For dates and times of the next free workshop in your area, just pick up the phone. Give us a call today. Call 844-343-6048. That's 844-343-6048.
What I'd like to talk about, and I teach at UAH at the Osher Institute. I've been privileged to be an instructor there for going on 12 years now. And you've probably heard our public service announcement we do for them, because I think that's just a great institution. There's so many classes that you can attend there. Boy, you can learn everything from different languages to arts to history to travel, political things. I teach a class called Changing Face of Retirement in the 21st Century that I modify every year, and they bless me by asking me to come back every year to teach that. And I'm currently in the fall semester teaching that. We covered estate planning, and we got a lot of questions on that. And I thought what would make the great second half of this show is to touch on the items in a good estate plan. In the first part of the show, I talked about the retirement planning checklist. Well, that'll get you into retirement, help you get through retirement. But what happens at the end of retirement? Well, it's important that you have a transition plan. And I think there's some misunderstandings about what an estate plan actually is. It's not just for wealthy people. It's basically about accumulating, preserving, and ultimately distributing your assets. It's having a plan. Just like I said, you got to have a plan to go into retirement. I hate to say this, you really need a good one to get out of it. Not that you want to, but it's part of the process of life. So it's making sure that all that you've worked for go to whom and to whatever entity you want it to go to. If you don't do that, well, you incur a lot of legal costs. You incur a lot of stress on the family. There could be tax issues by not doing things correctly. One of the things an estate plan could do is help prevent Medicaid spend down. Now, we've seen change in, a lot of people, when you say estate plan, they automatically think of the federal estate tax. Most people are not affected by that anymore. They've raised that to such a limit that the federal estate tax, at least for the time being, for the next few years, will probably not affect most people in the listening audience. If it affects you, great. You have done really well. But most families aren't going to be affected by that. What estate planning means for them is making sure that when your loved ones are dealing with your departure, that you're not leaving them with a lot of tough decisions. And there's a lot of tensions that can happen in a family if you don't have an estate plan. And it really does cause a lot of emotional trauma. So you're going to help your family through that. I use a tool in the interim planning of that called the beneficiary directory, which a lot of my clients have found very helpful. And as a matter of fact, would be happy to give out for the first 3 callers a workbook, a beneficiary directory workbook. If you'll call 844-343-6048, that's 844-343-6048. For the first 3 callers, just ask for the beneficiary directory workbook, and we'll get the information, get that mailed out to you. That's a good way to start. Now, let's take a look at what makes a good estate plan. Well, having a clear plan for the disposition of your assets, spells out who gets it and what they get. There are ways that it could be that you got a will. You're trying to figure out whether you need a trust, and we'll cover that as we go along. But it's what that will says, where it goes. Now, there are other things you can do too. And for those who are sitting here thinking, wow, I don't have a big estate. I've got several IRAs and, I got a brokerage account, a couple bank accounts, and my house, but that's pretty much it. Why do I need to go through an elaborate estate plan? Well, what you want to do is have a will to cover those personal possessions, and then it might be using payable on death or transfer on death forms to get those transferred without going through probate, because probate is that process you've got to go through to prove your will valid. In fact, that's what probate means. It's to dispose of the assets. In the state of Alabama, there's a 6-month minimum probate period, so you got to keep that in mind. And so what I always coach people is try to have as little financial aspects go through that will as possible. And that's a discussion to have at another time of whether you need a will, whether you need a trust. Today, we're just talking about things in general, having an estate plan. So you die, it goes to probate court, and there's 6-month waiting period so that it allows creditors to make claim to your estate. And what that means is, for example, if you've had a new roof put on and you haven't finished paying the roofer yet, you die. Well, it gives him 6 months to make a claim to your estate so he can get paid for the work he did. Any other creditors as well. So just remember that. That's why that probate period. Now, when you use a beneficiary-driven plan, whether it's through your 401ks, your IRAs, your brokerage accounts, where you're actually naming a primary and successor beneficiary, you can bypass that probate process. Another mistake when it comes to beneficiary forms is not having a contingent beneficiary, not having a secondary beneficiary. And that's critical, because if you're naming your wife and you both die in a common accident, it's going to have to be probated. There's going to be some issues there. It may cost the kids some money or grandkids some money. So again, one of the things I do with my clients is do a regular beneficiary review so that these little issues don't happen. And that's something you need to be doing with a financial advisor if you have one. If they're not asking you to do a beneficiary review periodically, and I'm not talking about every 10 years, I'm talking about, maybe every year or two as part of your annual review process, then you need to ask about that. Why are we not doing that? This is important. What a financial advisor does is he brings value to the equation. Bottom line is, if all a financial's doing is showing you investments and making a commission, then you need to look at that arrangement, because a true financial advisor needs to really be helping you, coach you through these things we're talking about. Not just the right investments, but your beneficiaries and how your estate is set up. Now, I'm not talking about a financial advisor practicing law without a license. You need to do that through an attorney. But there are questions a financial advisor should be asking and providing you information so you can go do that in the most efficient manner possible. So as we look at things, of course, you got the will, you got your beneficiary-driven designations, and a lot of people say, well, do I need a trust? Okay, well, you might. The people that would most benefit from a trust are, for example, somebody who owns property in multiple states. Because if you do, you're going to have to probate that will in each state. Now, it's not that you need a will in each state. It's just if you are a citizen of Alabama, you're going to have to probate your will in each one of those states, which adds cost to it. Whereas a trust avoids that. And where that would come into play, let's say you own a mountain cabin in Gatlinburg and you've got a condo down at Destin, and your home here in Alabama, and maybe some inherited farm property in Mississippi. Well, you're going to have to probate that will 4 times because of that issue. Whereas a trust, you wouldn't have to probate it all. Wills are public knowledge. Trusts are private. That's a main reason a lot of people use trust. If you have business entities, if you have substantial assets, those are some of the reasons to do trust. If you've got issues where maybe you're not real crazy about the guy your daughter married, well, you can set up provisions in the trust to take care of those issues, to where she gets that money in certain conditions and he doesn't. So there's a lot of things that come into play with a trust. And when I'm speaking of trust, I'm just talking about a living trust, and that's revocable. And again, I'm not trying to practice law. I'm not a lawyer, but these are the questions you need to be asking a financial advisor to direct you to the attorney he works with. In fact, today when I was doing my class at UAH, I had the attorney I work with a lot, who does a lot of stuff for my clients, he always comes in and helps me with that class, because it's good to throw things off each other to make sure all the bases are covered. Now, you can also have irrevocable trusts, and that's where you've got those special family issues that once that's done, it's done. There's no changing. When you have a living trust that's revocable and you're the trustee, well, you can make changes throughout your life until you die. Now, once you die, that ends that. But it's important to know the difference between a revocable and irrevocable. Once that irrevocable is in place, it's it. You have special needs trust, and maybe you have a child that's got a mental or physical disability or limitation, and they're getting government benefits. Utilizing a special needs trust can be critical to allow you to help provide support in the right ways that don't jeopardize their government benefits. So keep that in mind. Another key area would be having a durable power of attorney, and that allows your spouse to make decisions for you. Most people don't realize that you could come to a situation where if you're not there to say it's okay for your spouse to do things, they may not be able to do things. I got a rude awakening when my daughter she was having neck problems, and I sent her to a chiropractor friend of mine, and he's also a client. and she was very pleased with the services. She ended up later having to need to get an operation because it was a deeper problem than he could fix, and that helped her. But we went to lunch soon after that, and I said, well, how'd things go with Bonnie? And he said, well, Brad, I really can't disclose that. She's patient. And I said, well, she's my daughter. And he says, well, I know that, but HIPAA precludes me from discussing that with you because of her age. And I was like, oh, okay. And that was kind of a rude awakening a few years ago when I found out doctor can't even tell me about my daughter's issues, who's still a minor, because of HIPAA. Well, same thing applies to spouses. So having a durable power of attorney that is in place that would allow them to be able to talk your spouse or to you about your spouse is critical. I mean, it's critical. And as a matter of fact, would be happy to give out for the first 3 callers a workbook, a beneficiary directory workbook. If you'll call 844-343-6048, that's 844-343-6048. For the first 3 callers, just ask for the beneficiary directory workbook, and we'll get the information, get that mailed out to you. That's a good way to start. The next thing probably that's really important is an advanced healthcare directive, and that is telling them when to pull the plug. What are your wishes in the event you're in a coma or a like situation, and do you want life support? Do you not? You got to put that in writing in advance. We all remember the Terry Schiavo incident that caused quite a bit of consternation among her family and the nation for that matter. So we look at all this and we put it all together. You got your will, you've got potential trust, whether it's revocable, irrevocable. You got your durable power of attorney. You got your advanced healthcare directive. All these are components of a good estate plan. And a good estate plan needs to be revisited on a regular basis, not necessarily to change it. But if you haven't written a will in 20 years, you might want to look at that again. If you have written a durable power of attorney 10 years ago, you might want to look at that again because some laws have changed that may make that bank not accept it. So you need to check into that. And again, these are things that working with a financial advisor who takes the holistic approach, that's why it's important, because it's the advisor saying, do you have this? Do you have that? And when did you get that? And when did you last update it? All these are critical pieces of information that are necessary to make sure you have a good estate plan. So I will conclude my estate plan segment on that. And again, if you are interested in getting one of our copies of the beneficiary directory, which is a great tool for helping you start to figure out how to do the plan. It actually walks you through finding things and cataloging things. And that way, when somebody comes in behind you, there's a catalog, there's a directory, and it's not really that difficult. It just takes a little time to do. But if you want to get one of those copies of the workbook, the beneficiary directory workbook, I'm going to make those available to the first 3 callers at 844-343-6048. That's 844-343-6048.
At Brad Williams Financial Services, our goal is to develop enduring, long-term personal relationships with our clients, knowing that you have placed your trust in our expertise and dedication. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Are the gifts you plan to leave behind really safe? Learn how even the most generous plans for your assets you intend to bequeath can be undone by taxes, legal snags, healthcare costs, and other avoidable pitfalls. For your free commissioned report on estate planning, call 844-343-6048 or visit us online at askbradshow.com. Learn what you need to know about how to protect your estate against excessive taxes, how to spare loved ones the cost and headache of probate, and how to avoid the most common estate planning mistakes. For your free commissioned report on estate planning, call 844-343-6048. That's 844-343-6048. Or visit us online at AskBradShow.com. That's AskBradShow.com. Call now for your free report. Make sure the gifts you plan to leave behind will be safe.
You're divorced. You die. You forgot to change your beneficiary on your life insurance from your ex-spouse. Question: does she get the money? Well, that's changing, folks. It used to be yes. But more and more states are changing that law, and guess what? The Supreme Court agrees with them. In fact, in a recent case, Sveen versus Meelan, the Supreme Court ruled that life insurance proceeds would not go to an ex-spouse, even though her name remained on the beneficiary form after the divorce. And this happened in Minnesota. Now, I've actually seen this, folks, when I've sat down with folks who's come in to see me for the first time and they've brought their forms and we've looked at things, and, you know, there's plenty of second marriages these days. And I've found in more than one occasion where beneficiaries have not been changed. Well, in the past, that meant that the ex-spouse got a windfall, but that's not the case anymore. And this applies to IRAs too. And we're going to get into all those details. Now, basically it happened when this gentleman bought a life insurance policy, named his wife as primary and his children as contingent beneficiaries. And they got divorced in 2007. Now, mind you, that's 10 years. And the divorce decree made no mention of the life insurance policy, although it did award Kay both the snowmobile and their all-terrain vehicle. Wow. Of course, I guess that's what happens when you live in Minnesota. But he never took any action to change that. And he died in 2011, and she remained the primary beneficiary. Well, in 2002, Minnesota had amended its state probate code, and it applied what's called a revocation upon divorce statute to life insurance beneficiary designations. Now, in the past, we've always looked at a life insurance beneficiary as a contractual obligation to the insurance company, and that's no longer. So the way the statute read was the dissolution or annulment of a marriage revokes any revocable beneficiary designation made by an individual to the individual's former spouse. And really the end result of that is that if one spouse names the other on a beneficiary designation form for non-probate asset, what that means is, life insurance IRAs, they don't have to go through the probate process. They go directly to a named beneficiary. But under this new law, their divorce automatically revokes that, and the funds go instead to the contingent beneficiary. And that would be that secondary beneficiary, whether it be the children or someone else other than the spouse. Now, this went all the way to the U.S. Supreme Court, and they upheld Minnesota and said that the benefits should be paid to the contingent beneficiaries. So I guess their rationale for that is that a person would not want his ex-spouse to benefit from his insurance as to collect under his will, or, the fact that, I guess when you really put it into plain terms, is that his failure to change the beneficiary after a divorce is more likely the result of neglect and not choice. And so guess what? It goes to the contingents. And that is a big issue, folks, because it tells you even more why regular reviews of these documents are so critical. And, this article is in Ed Slott's IRA Advisor. I'm one of Ed Slott's elite IRA advisors. We're specially trained and go through pretty rigorous training and certification. and he keeps us abreast of all the tax laws pertaining to things like IRAs and things like this. I am proud to be a member of that group, and it gives me some great information. He's got a website, IRAhelp.com, that's got a lot of great IRA information. Also allows you to find good IRA financial advisors who've been certified through his program, well, like myself. But I think this is a really key story simply because it affects so many people. Divorces are fairly common these days, unfortunately, and making sure you do the right planning is really critical. I'd like to offer the first 3 callers a very special gift, which is our 2-part beneficiary designation planning document. It's a book that describes the beneficiary directory, which I think is a great tool I use with many of my clients, and the workbook, which will help you work through it. It will help prevent the types of things we're talking about on the show today if you keep it up. As in anything, you got to set it up and keep it up. But I'd like to give that to the first 3 callers at 844-343-6048. That's 844-343-6048. Folks, on Amazon, it's like a $45 value. I'm giving away 3 of them free. But it's a key item in planning, folks. You got to make sure that money that you've worked so hard for goes to the people that you want it to go to the most. Now, we talked about in the first part of the show how this affected life insurance. Well, folks, it also affects IRAs. And that's kind of a new thing because there have been some court cases in the past that reflected the beneficiary as a kind of sacrosanct on the retirement accounts, but that applies only to ERISA retirement accounts and those that are covered under Employee Retirement Income Security Act. And that is 401ks and pensions. Traditional IRAs fall under the state issues. So even though you did not change the beneficiary on your IRA, that means that depending on what state you live in, it could go to the contingent. And that is why it's so important that you have a contingent beneficiary. I looked over documents that people brought to me when we first started working together, and they'll have one beneficiary. And a lot of times it's innocent. You know, they're meeting with somebody, maybe at the bank or the financial advisor. You ask them beneficiary, and they obviously say, well, my spouse. Well, how about a secondary? Well, I don't know. Let's talk about it and we'll get back to you. And nothing ever happens. It's best to handle that then, even if you want to change it, because what happens if you both die in a car wreck on the way home? If it's a retirement account, it goes through probate. And so you don't want that. So make sure that you handle that right up front. And now in the state of Alabama, as of 2015, the same issues apply as they did in Minnesota, where the ex-spouse doesn't necessarily stay on as the beneficiary. So, folks, this only adds to so many topics that I cover that these issues need to be addressed on a regular basis, and they need to be dealt with working with a professional who understands it. Unless you're a lawyer or something like that, and you understand them well, you can probably do it yourself. But most people, they need help with all this. And primarily they need help so that people can remind them what needs to be done and how to do it. Now, Huntsville and North Alabama, I hope you have a great next week. Again, if you have a question that you would like me to address on air, I'll keep you confidential. Or you've got a show topic you'd like me to cover that maybe's affected your life, just email me at brad@askbradwilliams.com. And just like it is, ASK, brad@askbradwilliams.com. And I'll be happy to address that as soon as possible. Again, thank you for listening, and I look forward to talking to you next week.
That's all the time we have for today. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844 888-343-6048.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC are not associated entities.